Folks, this continuation of the chapter on stocks, and we have about 20 slides left on this, but this is the section on market efficiency. EMH, efficient market hypotheses. We sort of left on this slide. This is chapter 7. So efficient market hypothesis has definitely, we have gotten a little bit of news because courtesy Eugene Fama, who got a Nobel Prize back in October of 2013. So question often comes about, is why are price changes random? Because there's a whole group of people who continuously want to predict the prices, because obviously it can be very profitable if you know what the price of what you're investing in is going to be in the future. But if you recognize that prices react to information, and by information I mean truly new information, and that the flow of truly new information is random, and it actually doesn't really matter whether it's very significant information or less significant information, because even the less significant information can either trigger new significant information, or collectively a lot of seemingly insignificant information can become significant in some form or shape. And so therefore price changes are random, end of the story. That's why a lot of people who are sort of well trained in mathematical methods and electrical engineering and space scientists, I worked with all of them. They initially think, the price path of a security is basically approximates that of a sinusoidal curve, and it looks perfectly nice in hindsight. But when they apply their processes, there's always disappointment. And I think the disappointment comes from sort of like not recognizing that there's a difference between an explanatory model and a predictive model. In a predictive model, the most influential variable has not yet happened. So in a way, what data, this is a line of mine, what are you looking at? The most important data point is not in your data set. And you can do a thought experiment of the market turning points, from 1998, let's say LTCM crisis, the 2000 dot-com crash, or September 11, the Enron blow-up, which resulted in more erosion of value in 2002 than in 2001. Actually, just FYI, the market actually was higher a month and a half later after 9/11, contrary to popular or general belief. It was 2002 that really broke the back of the S&P 500, and an 18-year bull market from 1982 to 2000 came to a screeching halt over those 3 years from 2000 to 2003. And more recently, the blow-up of Bear Stearns, Lehman Brothers, these are truly unpredictable new pieces of information. Anyway, enough said on that. So efficient market hypothesis, like I said, basically the chief items there are that security prices adjust quickly and accurately to new information. And this is, I already talked about it, what is new information. New information is definitely not the editorial section in the newspaper next day, because that is just an analysis of what has happened. And efficient market hypothesis is developed to explain the observed random walk pattern. What are the assumptions of EMH? Now you'll see, remember this was like constructed in the late 60s, 70s. And some of them, they're so true, and some of them have gotten a real relaxed because of technology and change in the market space there. Knowledgeable investors are constantly monitoring and trading any given security. That's so true, actually. The markets pretty much, especially if you look at the 6-asset capital market that I have sort of mentioned to you guys, and the MAC paper that I've done is a formalization of something I've been talking about last 8-9 years, is the currency market, the commodities market, the real estate market, and then the 3 major equity markets around the world, the US, Europe, and emerging markets. If you think about it, they're trading 24/7, you know. And in fact, in some parts of the world, they actually trade on Saturdays and Sundays, and Fridays can be off. Israel trades on Sunday, and things like that. So they're constantly monitoring and trading, you know. Information is widely available and is free. Now, this was very severely questioned back in the 70s, but now if you think about it, you know, with your phones and your tablets and so on and so forth, and forget that, that's just technology. I think it's more the ad-supported revenue mechanism of companies that provide information or bring information to you. Because of that, information is sort of like the direct cost is free, right? As opposed to the indirect cost. Sean?
It also says to all investors at the same time. Is that necessarily a true assumption?
No, I mean these are the initial, you know, assumptions, you know, because you know you're working in social science, so and that's why I said you relax those assumptions. But when you build a model, you know, you have to start with some of them. But we can actually relax some of them, and you will see that the model just becomes a little bit more intricate. So instead of just one slope, you know, there'll be like 2 or 3 some kinks there. And in fact, you know, relaxation of that, I would actually say back in the 70s, there was a lot of discussion about that. Obviously not. And in fact, a breakdown of that is insider information. You know, if some people get information before others, you know, that's a problem. But now another way to think of it is think of an earnings release webcast by Google or Microsoft. I mean, that's like simultaneously webcast to maybe 20,000 analysts, not to talk about the excited investor who's following it, you know. And it's there in video, you know. So in that sense, you know, the playing field has been leveled to a great extent. And so the market efficiency has gone up, but still, you know, people find ways to break the system. And information on events occurs randomly. So I've already talked about that. And you guys have to think about it. And you don't have to accept what I'm saying. And by the way, this is not my view here. But you have to think about it, you know. I mean, we are actually morphing, as you know, the last presentation on behavioral finance is, we've sort of done a lot of the nuts and bolts of finance. And one of the things that it's not I struggle with, it's like, I want to give you the full picture. I don't want you to leave this class thinking that, oh, you know, finance is just so exact. In fact, it's anything but exact, you know. It's like I say, successful investing is a blend of rigorous science and beautiful art in that order, you know. So eventually it is art, but you got to do the science. And so you have to sort of just absorb it and think about it. Investors react quickly and accurately to new information, causing prices to adjust quickly and accurately. The reason I have put this in color is because I think this is where the opportunity to make some profits there are. And this is what not distinguishes but separates a very trained investor from someone who's basically following the herd. Because frankly speaking, investors do not react quickly and accurately to new information, you know. And you can start a simple thought experiment, like you can go 7 of you to a restaurant, and one person can be designated without telling the others to have a stopwatch and see how much time people take to order their food, you know. The information is there in front of you, which is the menu and the prices, you know. But everyone's risk tolerance is different. In this case, everyone's tongue is different, and their budget is different, and their mind is different. And you see that they take different amount of time. Some people will be like, I bet you guys know this. They're like, eventually they're like, all right, I'll go with what you're taking, you know. Right? I'll go with what you're having. Well, that's like, okay, you know, Dow's at 16,000, let's go buy it. You must be a good reason. Everybody's buying it. They've done their analysis. Who am I, you know? Right? So these are actually a very interesting chapter, actually. But you cannot understand this chapter without some of the things we have done before. And in a way, it goes back and forth. You realize that a lot that is sort of seemingly exact material that we have done, it sort of, it all adds towards this, and yet it does nothing. three forms of market efficiency: strong form, semi-strong form, and weak form. The weak form one is the easiest to actually accept, and I seriously urge you guys not to do that. A lot of Main Street does that, a lot of even Wall Street does that, because I've been on both those streets. And what it is basically weak form efficiency says that current prices reflect only or all the information contained in past prices. So if the Dow is at 15,900, it reflects all the information that's there when the Dow was at 12,000, or when it moved from 15,500 to 15,999 and then come back and all that. So basically an implication of that is looking at past prices is not going to do you any good. Because not only everybody can look at the past prices, the current price the past prices are embedded in the current price. The semi-strong form says current prices reflect all publicly available information. This information is management information, product information, economic information, accounting-based information, every piece of information, income statement, balance statements, anything that's publicly available is reflected. So if you try to scrub the balance sheets a little bit more and think that, oh, you know what, this relationship, this acid ratio, this DuPont analysis, what do you think? I mean, we're sitting here in Orono, in central Maine, north central Maine, we are, this is a book that I used at Drexel. This is a similar version of book I used at my class in Cambridge back in '98. The material is the same, the William Sharp is the same, the Sharp ratio is the same. So basically you're being trained in the same methods, and there are probably 500,000 trained financial analysts, they've done that. Strong form is where some of the discussion can happen, is that current prices reflect all information that can possibly be known. So all information is, you can write public and private. So if, let's say, Apple is thinking of merging with Walmart. You're laughing, but you never know. Maybe I know something that nobody else knows. Right? Then obviously somebody has to be talking about it. It's not public information. It's somebody's idea. Tim Cook maybe. So Tim Cook says, hey, to his assistant, says, hey, can you set up a meeting with some people there in, Bentonville, Arkansas? And then suppose a lot of flight activity goes back and forth between Bentonville, Arkansas and Santa Clara, So maybe something is happening. But those pilots and truck drivers, they may know something, and that's private information at that time. Strong form says that even that private information is actually reflecting in the stock price. Research has shown all private information does not reflect in the stock price. That is the basis for insider trading. So market players know that they call it abnormal profits. Abnormal profits are profits in excess of what is suggested by the beta of a security is possible. So abnormal profits are possible if there's inside information, but there's a problem with it. It's against the law, So I've already talked about this. You can read this. Can't profit by looking at past trends. That's what weak form says. So at least do not disagree with the weak form market efficiency. And at least one thing you should take away from 651 is do not value a stock, a market, a sector, or an ETF by its position on a price graph. This market has been going up for the last 4 years now. There have been times when it was going down, so then you would go short it. You'd go short it, you'd be right maybe for 5 days, 5 weeks. This took off. Basically, you come back to the Dow. I remember the Dow, 6,900 to 15,900 today. So that's 9,000 points on top of 6,900, more than double, So you cannot value even the Dow by looking at its price path. Forget about companies like Netflix or Google. Semi-strong, all information is reflected. So it doesn't pay. So I'm adding a little more granularity, or not granularity, explanation. Doesn't pay to pay over annual reports, pour over annual reports. If that was the case, let's say, why would it take 1 year for subprime issues to eventually sell off? Bear Stearns went bust in March of 2007, I remember. In fact, I must say to you, and it's there actually on my website, I created a list of finance companies that were in the mortgage business for the MBA residency week in August of 2007. In August of 2007. And the market was still going up, in August of 2007. So analysts like me, let me see if it's still there, had an idea, that it's possible. The ETF portfolio covariance, both of these are my sites. Correct Charts and this advancedportfoliosolutions.com. This I created in 2004. I don't maintain it. Oh, it went to this, it redirects to that. I don't like that anymore. See here, right here, see? I'm sorry, I was off by a month. August 2007, I said. A list of firms affected by the subprime financial crisis, September 2007. The market tanked in July of 2008. So analysts, and we talked about trained analysts poring over public information. Obviously, I created this list based on public information, right? I was telling you that things are not good. I literally was actually laughed out of a room for saying that there's a subprime crisis looming. Someone actually said, what are we talking about? I know everybody, they're paying their mortgages. It looks fine to me. I remember that. I wasn't laughed out, but yeah. The messenger gets short, especially bad news. And risk is a 4-letter word. Nobody wants to hear about it. And the reason is basically because people who are hearing it, they are exposed to that risk. So then, so basically they're invested. So if you're saying, it's not going to do well, basically it's a lack of confirmation or confidence in what they're doing. But here it is, list of firms affected by subprime crisis. So I can make it real, from these slides, and I try to do it, but there's only so much time. But you can check it out, the list of firms there. I'll try to show you something. So anyway, right here, what's the tangent here? Why did it take 1 year sell-off for subprime issues? That's where, guys, your opportunity is, if any of you are in this business, to make some money. Investors react quickly and accurately to new information. It's one of the fundamentals of EMH. And it's not that I beg to disagree. I have to disagree, because if you are a reasonably ardent student of the marketplace, you see it doesn't happen, it takes time. I mean, I know exactly where I was on September 11, 2000 and September 9th. What is it? What day was it? September 11, 2001, right? Yes. I mean, half our team was playing golf in Hawaii, I mean, actually, we were based in Philadelphia. I was on the team managing an $18 billion fund. That's $18,000 million. You think we sold anything that day? I mean, that day the market was closed and the market opened. No. For people to come back from Hawaii, it took time, And then smart managers, and you guys will be doing management. Smart management and genius managers are different. Smart managers are really good at not making any decisions. And they actually get into pretty senior positions. The genius managers like Jack Welch, they'll stick their necks out and they'll do something different. But a very safe management technique is not to do anything, to keep talking about it and do nothing. It wasn't until 20 days before some trades were, authorized. And a large fund like that is like a super tanker. Super tanker, you see a little iceberg in front, you're going to just suddenly change course. I don't know. I've never been captain of a ship, but I don't know. I don't think it's that simple, So anyway, guys, that's that point, and it seems like it's a non-mathematical point, but I can add flesh to it because I mean, that's one of the reasons I'm here is, the university here wanted someone with practical experience who has actually run a portfolio and done portfolio management, architecture analysis. So if I don't bring that to the classroom, you can read these slides on your own. Already said strong form EMH. All information, according to it, is embedded, but it's not true. It's not true, and also it's illegal. So you can read this the same information here. 100,000 or so trained analysts, MBAs, MS, finances, CFAs, PhDs that work for firms. They have similar access to data and megabucks to invest. Thus, news is reflected in P naught almost instantly. Your behavioral finance, if I have time, I'll give you a little bit more. You have some background, the team last time did a good job, great job, getting some of the fundamentals there. I'll try to do a thought experiment, try to post actually an online exercise where you can participate in it. Behavioral finance, so you can't, based on some of the valuation ratios and metrics we have seen, it's sort of difficult to explain the volatility of valuation. So behavioral finance comes in, it incorporates elements of cognitive psychology to better understand how individuals and markets respond to different situations. And the core of behavioral finance and why it was initially sort of pushed back and rejected was, once again, the same thing. The core of it is that investor rationality is questioned. Investor rationality is questioned. It's basically you saying to me that, because I don't want to say that to you, so you can say it to me, I can handle it, that Pank, you're crazy, or Pank, you're stupid, or Pank, you don't get it, or Pank, you're not rational. I don't want to, I can handle it, but I don't want to hear that basically, But Kahneman and Church are basically saying, based on the work of Simon, who got a Nobel Prize too, in psychology back in the 50s, saying that investor behavior, it's called the concept of bounded rationality. You know what bounded rationality translates into legalese? The insanity defense. Do you see the link there? That means we are rational up to a bound, up to a boundary. After some of those thresholds are crossed, our rationality is not guaranteed. And that's why seemingly rational people, they do like really, really crazy things, Our discussion of the Bitcoin today could be part of that building of that mania, where everybody, it's the right thing to believe in that. The right thing to believe in the tulip mania. It's the right thing to think that, Amazon should be $800 back in 2000. Well, at that time, it wasn't the right thing to think that Amazon should be $800 because it traded at like $20 2 years later. Today, it trades at the equivalent of $2,400. But go and talk to that person who shorted Amazon at $800, or went long actually at $800. They're not alive, anymore, or they got that position killed. So types of analysis. This is where you guys come in. This is where a job is there. So one is about, lifting money out of the ocean. Remember, it's a deep ocean. The other is, is being the captain or the co-captain or the engineer on a ferry boat, where you just take people from one island to another, and they'll go there to pick up the seashells and find some things there, but you just keep doing back and forth. So there's a great job waiting for you guys if you want to do fundamental analysis or technical analysis. If you do technical analysis, basically it means that you do not agree the market is weak form efficient. These people, interestingly, get paid like north of like $500,000 a year actually. So on the one hand, you see weak form analysis, but some of the best technical analysts in the market, they get paid more than $500,000 a year for studying charts. They're called chartists, And now there's a lot of software that does that, so maybe the prices have come down. And then fundamental analysis. This is the bread and butter of financial analysis. in the financial institutions. This is where you say that the market is not strong form efficient. That means all public information is not reflecting. If I analyze past earnings, balance sheets, economic macro analysis, management quality, industry prospects, I can add some value. However, if you truly believe in semi-strong efficiency, then this is doomed to failure if this information is public. So if you come back here to my website, a list of firms affected, in a way I was doing fundamental analysis. But it's like maybe people are, but of course, I don't have any outreach there, but people are maybe thinking that, you know what, this information already reflecting in the price of this security, so there's no real value, or there's no basis for me to take a position in this. That's why you have so many mutual funds. You have the more mutual funds than the number of stocks on the exchanges. Why? If we are so convinced about it, but we can't convince anyone, 5 of us, we can start, portfolio 651. Go through the process, launch it, SEC. It's sort of, something that I think about doing sometimes, frankly, with my students, we could create an ETF, we could create so many different things, and then we don't have to convince anyone. It's our money, and if we generate some profits and if we have decent marketing, then we can get more money to fund that portfolio. There's a doctor at Stanford who became very famous for shorting mortgage-backed securities in the 2007 build-up towards that. And so he's a full-fledged doctor at Stanford. And then he started writing a blog, and people got interested, and his analysis was damn good. And eventually had something like $5 billion under management. Let's start a curiosity. See subprime mortgage blow-ups, August 2007. So here's some, look at these pictures. Can you see that picture? See, this is the fun stuff. I love history. History was one of my good subjects when I was a kid. Look at that. Try to do price chartism on this. TARR from $30 down to $0. So these things blew up actually. Look at that. Investors were holding these. This is Doral, a company called Doral, $1,000 down to $0. Why would you not double up at $300? Why not? The home builders ETF went from $45 to $15. So 2/3 of its value, 67.7% gone, and that's an ETF. And look at the increase in volume. So all of this, it just shows things. And that's, of course, some graphs there, and that should be a list. You see? See, that's a little bit fundamental and quant. You got your earnings per share, price to earnings, forward PE. See, who cares for PE? I mean, we talked about it briefly, but in the real world, you got to look at forward PE. Last earnings don't matter. Beta, max market value. And see, this information wasn't there. I had to write some formulas there to get this out. Left FN, LEN, F7, -2. So obviously there's text-based information because LEN means length of a string. And see 1.75B, so that's obviously text. So I'm getting strings out of that. And see, here's the erosion of market value, -54%, -98%. And so at that point, there was what, $41 billion was the market cap erosion at that point. So these companies were still at play. That would be a good short portfolio, I guess, at that time, right? Because you would have probably covered this portfolio at 5% of its market value. Can you believe that? That'd be nice profit to pocket. But then it'd be a dangerous trade, right? So there are opportunities to make money, but then there are a lot of other issues. So that's fundamental analysis, and I encourage you guys to, do that. There's a chapter 3 on financial statement analysis, which I don't do in class. I encourage you guys to look at it. especially those of you going into finance. It'll help you with some other classes also, and things like that. 7:33. I see Mike is looking carefully at this. This is real here, Mike. This chart here is an amazing. This brings me back to 2000. I used to be part of some market blog, and my nickname there was Volatility Smile. So the Volatility Smile, and yeah, the more volatility we used to, the quants always love volatility because volatility is a constant, and the more volatility there is, the more money sort of you can make, in a way. But then there are one or two trades where you get wiped out, Right. But here's what this is. So there was a lot of informed traders on that site, and they used to trade the QQQ, which was a little bit new at that time. QQQ is the most actively traded ETF in terms of volume, What is the QQQ? The NASDAQ. I mean, that's the NASDAQ 100. It's got the Dells, the Microsofts. There's no liquidity issue there. So the question, so I actually created this graph. They asked me, they said, hey, Pan, can you do that? I said, sure. So we took a survey of all the traders there and portfolio managers. And we said, okay, what is it? Yeah. I mean, the market can be wrong. And on 12/18/2000, we said, what do you think the price of the QQ is going to be next 6 months or something like that? And you can see it ranged from a low of 60 to 100. I was trading around 120, I think, or maybe 100. I don't remember. You know what? It was probably around 80, actually. It was 80. From 120, it went to 80. Yeah, 120, it went to 80. So 30% it was down. The whole market was down 30%. And here's the number of people who participated in that poll. And so that's where, in a way, the market. And the low price was 60. I don't have time, but you know what the low price on the QQQ was in 2003, March? $19. So you see what I'm saying here? Is you make a forecast here. A whole market is down 30% already, from 120 to 80. And still, it keeps losing value there. So even the market can be wrong. So one of my favorite lines, this is not my original line, I heard it during my work, is the infinite wisdom of the market. Don't believe in that too much. But don't be a contrarian too soon. I was chatting with some of you. Some very analytical people are typically contrarian. They're just like anything, they just have to go against the grain. But I've seen it. Don't stand in the path of the charging bisons, They'll trample you. Eventually they're going to fall off the cliff. But before they fall off the cliff, you're going to be trampled. So don't be a contrarian too soon. So if you're a contrarian basically here at $80, you're like, no, 80 is a good price. I'll buy it at 60. So remember anchoring? So you anchor to 160 and you make an insufficient adjustment. It's a classic example of that. So I think that chart is interesting. I can show you just real quick if you really, why not? It's QQQ. For all technology people, that's your space. There's no finance companies or healthcare companies in there. This is a very fast laptop. What is happening here? I mean, really. See, it's at $82 now. That was the median price forecast on that back then. Wow. Waiting for big charts. All right, what's their website? Not my computer. Let's do this here. Here, guys, look at that. So that forecast, see, time is important, you know. That forecast was done, if you remember, December of 2000. December of 2000, the price, you know, depends on a few days. I remember it was about 80 bucks, 73 bucks. So a very informed group of investors continued to be wrong for 2 more years. And then it literally took a decade to come back, and it's still not at its all-time high of 120, but it's back to 82. Isn't that interesting? I mean, history is sort of interesting. And this is unscripted, as you know. The most interesting parts of these lectures are unscripted. There you go. So this is 12/2000. The market thinks it'll be between 60 bucks to 100 bucks. And of course, that was not the case. Observations 48. Mean, median, all that there. All right, enough. So you can read through this. I've given you enough, background on this. You should check it out. So if you fundamental analysis, if you believe in weak form, it's worth doing. See, that's why fundamental analysts, they have good jobs in asset management companies. So looking at the macro scene of the economic system there, looking at company balance sheets, the betas, the price to earnings, that's good. But if you believe in semi-strong, it's a waste of time. If you believe in strong form, it's a waste of time. The implications of EMH are that future market prices cannot be predicted based on available information. The reason why there is so much resistance to this is basically it questions the livelihood and the basis of livelihood of thousands of people, right? If you can't predict prices, then why are you running a mutual fund? Why should I give you money? Why, on top of it, why are you charging me money for that? That's it. So naturally, you're going to get a lot of pushback. And some other things that you can read here. So what do EMH believers do? Do they do active management, which is basically security analysis, saying that, hey, you know what? I think that Yahoo's going to do better than Google because Marissa Mayer is there right now, and she's doing a great job. And so I'm going to short Google and go long Yahoo. That's it. That's a nice security analysis right there. Not nice means just how it is. It doesn't mean it's correct. Or timing. Timing is what that histogram I showed you. That's a histogram. Timing is December 2000 is a good time to buy the QQ because it's down 30% from $120. Right? That's the classic example of timing. But notice both those things can be wrong. Fundamental analysis on Amazon was wrong in 2000 because it was at 800. It was supposed to go to 1,000 next stop. Instead, next stop was $20. QQ, same thing. So what do? You do passive management. I once again encourage you guys, those of you who have not seen, there's a video I've posted at the beginning of the class. It's a PBS frontline video about about retirement and the impact of expenses on it. It's your money, your back pocket. And John Bogle started a big company called Vanguard. It's third largest in the world right now. And they basically have indexed funds. Index funds are basically buy and hold. Buy and hold. And you say, I don't know how to differentiate between a bad stock and a good stock. Because history, time and again, shows that the bad stocks become good stocks and the good stocks, they become really bad stocks. When that inflection point happens, everybody tries to find out, but sometimes you can, but consistently. The point is consistently. And so you do index funds. Now notice when you're doing index funds, you're taking on risk. You're taking on no idiosyncratic risk, but you're taking market risk. And if you're taking risk, you should be rewarded for it. And so that's why 75% of active funds or active mutual fund managers, they underperform the index any given year. And still the industry works just because the marketing is so strong. Wow. So real quick, active management. The security analysis, unique insight pays off. So unique insight, you think it pays off, but herding and behavioral conformity, they get in the way. People keep second guessing themselves. And here's a great line, and that's not my line, it's a line of Schifrin and Statman. And once again, as people who are going to graduate from this class, in a funny way, I want to warn you from falling in this trap. Investing, there's a difference between a good firm and a good stock. You can invest in a good firm, which can be a bad stock for you. Or you can invest in a bad firm, but it's a good stock. Amazon at $20 was a good stock. At that time, people thought it was a bad firm, it was just doing some internet selling and all that. So there's a big difference between a good firm and a good stock. A good firm, typically everybody knows about it, and so it's priced to perfection. So the expected return on that is positive, but the realized return can often be negative on that. But a good firm can remain a good firm for a long time. So just be careful about that. It's not about good analysis, but better analysis. There's something about framing in that, which I'll address later on, There was an experiment done which basically showed that 80% of car drivers think that they're better than average car drivers. Now that's mathematically impossible, right? So the same way you think that your insight into a stock or a stock pick is better than the others and different. What you don't realize is you are part of that majority group, There was some interesting study done that with a certain level of confidence, one can predict which year a person was born based on their name. They're like these waves that go through the country. Like for a period of 2-3 years, a particular name, Ashley, Megan will be popular. People don't know that's the name actually. That's popular. But a lot of people will have that name. And then it certainly gets replaced by some other name,
There's a website that charts that.
What's that?
There's a website that charts that.
See that?
It shows the names that are most popular in each state.
Yeah. Yeah, I probably saw a GIF on that, animated GIF on that through my Twitter feed, yeah. So having said all of that, this probably sounds like you're saying that, hey, Pank is saying that, hey, don't do any analysis. In fact, far from that, guys. You want to do the analysis, but for the right reasons, Like, you want to look at the speedometer, not to drive fast, but to drive carefully. So you want to understand portfolio architecture and construction and all of this. Why? There's a role for portfolio management to have an appropriate risk level, to have tax considerations, what tax bracket you are in, and what kind of, do you want high dividend stocks or you want municipal bonds? A big tax difference between the two, Other considerations, diversification, and diversification across asset classes. See, back in there, that's my slide there I've written, and now I've formalized, MAC diversification across asset classes. I can actually show you, I updated that. So, just a little section on preferred stock. A preferred stock is a hybrid security, similar to bonds, in that the stockholders receive a fixed dividend, but the dividend has to be paid before dividends on common stocks. But if the dividend is skipped, the firm is not thrown into bankruptcy, unlike bonds where a coupon is skipped and the firm can actually be, it's in default. The valuation of a preferred stock is something you need to do on homework and everything. Is extremely simple. It's basically an annuity, which is from Time Value of Money chapter. You can refer to it. Is basically the constant payment for infinity divided by the interest rate. In this case, the expected return. So the annual dividend, let's say on a preferred stock currently priced at $50 is $5. So 5 divided by the interest rate is $50. So just doing rearranging, you'll see basically it's 10% is the expected return on the preferred stock. And here are some of the homeworks. You should do that. And that pretty much concludes our chapter on stocks.